Hey everybody, it is good to be here. Friday, it's time for our advanced option strategies. Now, some of you may be going, I kind of don't remember this name. It seems like it was Condors, Calendars, Butterflies. We're going to be going through a lot of the same stuff here. We're doing a name change just because I think this is more descriptive of more of the strategies that we use in this class, including one that we're going to do today. And the one we're going to do today, I really like because I think it's more on the basic end of the advanced option strategy spectrum. It's a very practical strategy and it kind of connects an easier a basic option strategy with a more advanced option strategy. In particular, I'm talking about what we'd call a poor man's covered call. Technically not a covered call, technically a diagonal spread, but you'll see what I mean here in just a little bit. Before I get into it though, let me mention a few important things. One, if you want some additional financial content, you can follow me on X at BrentMooreCS. Also, Scott Thompson's in the chat helping me out today. Appreciate Scott. As you have questions, feel free to type those in the chat between Scott and myself. We'll do our best to get your questions answered. Also, a few more notes. One, options carry a high level of risk and are not suitable for all investors. The material today is for general informational and educational purposes only. It's not recommendations. We'll look at individual stocks today. Those aren't recommendations, everybody, but they're examples to try and help teach you. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. Paper money software application, which is something we will be using today, is for educational purposes only. All investing involves risks, including loss of principal. There's no guarantee of an execution of a stop order will be at or near the stop price. And past performance is no guarantee of future results. Schwab does not recommend the use of technical analysis as the sole means of investment research. I probably am not going to be factoring in commissions in our trades here today, but just realize, keep in mind, there are commissions and fees that we have to consider here. So now, I mentioned the name Poor Man's Covered Call. It's just an informal name. Technically, it's a diagonal spread, but I want to show you what it is here. But before we do so, I want to start with just kind of a regular plain covered call. I have the Dow Jones Industrial Average here, right? You can see the trend that we've been in on the Dow. Pretty similar, a little bit more of a pullback on the S&P 500 right now, but the general trend has been pretty good. But I'm just going to start with a stock, kind of a large stock, a lot of you are familiar with, and that stock is Schlumberger here. Okay, so I'm going to pull this up, and let's start off with just talking about a covered call for those of you who aren't familiar with a covered call. And if you are, just bear with me for a sec because we'll get to the variation of it here in just a little bit. But right now, let's start with a covered call. A covered call starts when you buy stock. And the stock that we buy, it needs to be in a 100-share increment. So I'm just going to talk about 100 shares of stock, okay? You buy 100 shares of stock, and great, stock goes up, you make money, stock goes down, you lose money typically on that, right? At the same time, you're going to sell a contract. I'm going to sell a contract of a call contract, okay? And what you do when you sell that contract, you agree to sell your stock for a certain price. So let's say, for example, the stock's going up and I'm going, well, look, I've got a nice trend up. I want to own that stock, 100 shares of stock, sounds great. But I want to sell it if it goes up to, $60 seems like a reasonable price here. That would give me a nice little profit on the stock, which is right here, right now. I'd be able to capture in the difference between the price I purchased it at and the sell price at 60, which is which we've agreed to sell it for by selling the call option contract. That's called your strike price. You can choose different strike prices. I'm just going to use 60 as our example here because that would mean the stock has gone up here. And I think for a lot of you, you'd say if the stock went up there, it's likely it would take a little bit of a breather. just like it did when it went up here. Took a little bit of a breather. It went up like this. It took a breather. It went way up. It took a breather. That's kind of the gist of this right now. But here's the good thing. I'm not just agreeing to sell it for the strike price. I get paid to do so. So let's just look at a quick example here of that as a covered call. So stock right now is at 55.13. And what I'm going to do here is I'm just going to bring this up and I'm going to say, how much would it cost for the stock? For 100 shares, it would be $5,513 for 100 shares of stock. You see where I got that? I just took this and I multiplied it by 100. Now the price has moved a little bit on me, but bear with me on that. That's good what's going to happen here. Then I'm going to sell the short call. And so there's I'm going to add in a short premium. Well, let's look at that $60 strike price here on this. If I go to the $60 strike price, and in this case, I'm just going to go out, I'm going to go out to the monthly contracts, 42 days out to expiration. I'm going to go out to the $60 strike. It's going to be about $1.06. We may be able to sell it for a little bit more because there's a good chance we'll be able to get a little bit more than the bid price, but I'm going to just put in that 106. So I'm going to sell that for $106. 106. Okay. What percentage, then the question is, what percentage of the cost of my position am I receiving as a premium here? I'm going to take $106 and I'm going to divide it by $5,513. And that turns out to be about 1.9%. 1.9%. And you're going, well, Brent, 1.9% isn't much. But keep in mind, this was over 42 days, okay? 42 days. 1.9% over 42 days. Maybe that's not such a bad deal, okay? So that works. That's a covered call. It's a very popular strategy. I'm not recommending it necessarily, but it is a popular strategy. But it kind of begs the question. You could say, well, $5,500 can be a lot of, more than I want to spend. What if instead of buying 100 shares of stock, instead I buy a long option? Okay, and so in this case, I'm going to do a long option. I'm going to go out, quite a ways, because this is supposed to be more simulative of a stock trade. So I could go out 595 days. These are LEAPS contracts, okay? Just long-term expiration dated contracts. I can go out 287 days. I'm going to go out to January in this case. I'm going to go to January, and I'm going to go in the money a little bit here. So I'm going to just kind of look at my delta on this. My delta here on this is 78, just to give us an idea, and we're going to remember that 78. And I'm going to buy that contract. 1335 is what I'm going to buy it for. So I'm going to consider doing the same thing. And you may be going, well, that's kind of an expensive contract, 1335. That's a $1,335 expense for that contract. Okay. If I were to do the same thing though, sell the same short contract, still $106. In terms of a percentage of the long position, if I take that 106 and divide it by 1335, I end up with about an 8% return. About an 8% return. So this is ramping up the percentage of returns of the short contract as compared to the long contract, okay? Excuse me, the short contract as compared to the long contract of the stock versus the LEAPS contract. Now, there's a difference between buying stock and buying LEAPS contracts. This is an options contract, okay? Number one, this has an expiration date. That's one difference, okay? If the stock pays a dividend and Schlumberger does pay a dividend, you don't get the dividend on the LEAPS contract. So you're missing out a little bit in that regard. And so there are some differences there. But I just need you to realize this is a way, if you don't want to tie up quite as much capital there on that, you can do this. Now, Wiley says there's a time decay component. Yes, let's think about time decay. The short contract is going to have a negative time decay component, okay? It's, in other words, time decay, well, it's positive theta, okay? Time decay is going to help us out on this, on the short contract. But on the long contract for the LEAPS, time decay is going to be working against us. So you're absolutely right on that, Wiley. That is a factor to consider as well. That's a difference between those. Stock, there is no time decay. So that's your time decay component. What about thinking about another Greek, delta? The Greek of the delta of 100 shares of stock is 100, okay? 100 delta. Well, let's look at the deltas of our short contract here. And let me go back to this. Our short, by the way, our LEAPS delta is about 78. But our short contract delta, which we said was going to be a $60 strike, is about 27. Well, let's just look at this. It is still a bullish trade. If you buy the stock, 100 delta, the short contract, 27, your net delta is going to be 73 on that. 73 net delta. In the case of the LEAPS contract, so that's for the stock, for the LEAPS contract, the delta we chose was 78. We just looked at that. The short contract, still 27. And so our net delta is, if I'm doing my math right there, 51. So a little lower on that, but you still get significant returns on this. If it's still a bullish position for the price of the stock, instead of a $5,500 investment, a $1,300 investment, I'm kind of rounding here on these, is going to give us 78% of the move there, okay? Just looking at the long positions on that. So that's the difference there. So let's put that in and talk about how we would manage that trade here. How are we going to manage the trade? Well, let's consider this. So first of all, how can we do the trade? Well, we're going to do in two legs. We're going to be selling a $60 call. I'm just going to click on that. I'm going to go down to my LEAPS contract. We're going to buy this guy, which is the $45 call. I'm going to hold down my control key though. If I don't hold down the control key, it's just going to replace the first trade with this trade. I want them both though. I'm going to hold down my control key and I'm going to pull that up. And here's my trade. This is the net debit of the trade, about 1,200 bucks. Okay, about 1,200 bucks. That's this trade. Now, that's how we can enter that trade. And now I want to talk about management and rolling and all that sort of stuff here in just one sec. When you do this trade, when you put this in, notice it's a mid, it puts it in, thinkorswim puts spreads in at a mid price, probably unlikely to get filled on that. So I'm probably gonna have to pay a little bit more than that 1187 here. We'll go up to about 1,200 bucks here on this. And I'm gonna confirm and send, and then I'm going to send that trade. Now let's look at the stock. Okay. Here's Schlumberger. What's gonna happen if the stock, we'll say, goes sideways here at this point? Do we lose anything on the LEAPS? We do lose a little bit. There's that time decay component we lost on that. But the time decay is going to be more rapid on the short contract. In fact, that short contract is out of the money. It's going to become worthless before long. At expiration, if we're not above 60, it's going to be worthless. So the LEAPS contract, time decay is slower on the LEAPS contract. And so if the stock goes sideways, that's fine. We're making money on the trade. Okay, we should be making money on the trade. Now, there's other variables in there like implied volatility that can affect the prices a little bit, but that's the gist of it. We're making money in this case. What if the stock goes down? Let's say the stock goes down. Okay, we just failed. If the stock goes down, we're going to lose a little money overall because of that positive delta overall of the net position, we're losing a little bit more. But the only reason we're doing this is we're bullish on this in the first place. This is a bullish trade. If you think the stock is going to go down, don't do this trade. Okay? This is a bullish trade. But if we're wrong though, and the stock starts to go down, okay, we've lost less than we would have if we just bought the stock though, or just bought the LEAPS contract, because the short contract is going to help make up. We'll make some money on the short contract. Overall, it'll help make up for some of the losses on the long contract. So, we're not going to be perfect every time in terms of guessing our direction. And if it does go down, that will benefit us a little bit. What if the stock goes up? What's going to be happening to this? Well, we'll be making money because it's overall a positive delta. The long contract is going to be doing quite well. The short contract, depending on how far it goes up, may not be doing so well. Okay. And one difference here between doing, say, the covered call and doing this diagonal spread, which we're trying to kind of simulate the covered call in a sense, one difference here is that we're not on a covered call. We may just say, hey, if it goes in the money, we'll just get called out. We'll just let them buy our stock. Well, I don't have any underlying stock for them to buy in this case. So this is the situation where we're going to manage this before we get to expiration there. All right. Now, how are we going to manage it? Well, let's think of the three scenarios. What if the stock goes up? Remember, the preface to this is we're only doing this if we're bullish longer term on Schlumberger. This would be kind of a substitute of if we were considering buying the stock. If we're bullish longer term on Schlumberger and in the short term it goes up, in other words, our short contract may be threatened a little bit, what we may do is we may roll that short contract out in the future. Okay. What if we change though? What if we change our forecast and it's no longer bullish? Our forecast is no longer for it to continue to go up. We think, hey, we think the stock's it's hit its top and it's gonna go down or for whatever reason. Then what you'd probably do is you just get out of everything. You'd buy back the short contract, you'd sell the long contract. You've made money because the stock has gone up in that case, and you're just going to get out for presumably a profit at that point. So as long as you're bullish, you can just stick with the LEAPS. You can roll that short-term contract, but if you turn bearish overall, you don't want to do the trade anymore, just get out of the whole thing. What if the stock kind of goes sideways? I'll just say neutral. Okay. What if the stock goes neutral? How are we going to manage that? Well, we're going to let the time decay work. Okay. Remember, net, we have a positive time decay on this. The short contract's time decay, which is helping us, is bigger than the long contract's time decay, which is hurting us. So we'll probably stay, and as long as we're still bullish long term, we'll repeat the process. We'll roll the contract, or we'll, close it out and then sell another one at some point. Okay. rolling and selling out and entering a new one is essentially the same thing, except rolling, we're just doing it in one order ticket. It does not save you on commissions there. Okay. Let's say short term, the stock goes down. How are we going to manage that if the stock goes down short term? Number one, I would say a lot of times, a lot of times, if the stock goes down, what we'll do if we're still bullish on this and we think it's going to recover, we'll just roll it. Okay, we'll roll it. If we're bearish on this, if it still goes down short term and we think it's going to go down longer term, we'll just exit the trade. Okay, we'll just exit that trade here. Okay, so if any time our forecast just turns bearish long term, we're going to get out of the trade, the overall trade on this. But by the way, let me just kind of circle back to if it goes up. You can be patient sometimes on this before you consider, because sometimes what a stock will do is it'll go up and then it'll retrace a little bit. And we'll be tempted to buy back the short contract when it goes up. But if we're just a little patient, sometimes, not always, it'll pull back and we'll be able to buy it back for a lot cheaper. Okay, so that's the management of this trade here. Now let's see what it looks like here in our portfolio. So that filled, and we're looking at Schlumberger right here. Here we go. We've got two contracts. We've got our long call, which is kind of our substitute for the stock, even though it's not stock. We already discussed how that's not stock. We have our short contract as well. The short contract is going to show as a negative quantity. That's how short contracts can show on thinkorswim. And ideally, the price of the short contract, in an ideal world, the price of the short contract would go down and the price of the long contract would go up. Realistically, what happens is often they'll kind of go the same direction, but remember, there is a theta differential here on these. The theta on the short contract right here is greater than the theta on the long contract. So all in all, time decay should be benefiting us on that trade there. Okay, so now if you have any questions on that, let me know. Otherwise, I'm going to do a different example here on this. Okay, Carol said the VIX is nearing 19. Okay, so keep in mind, let's talk about the VIX here for a sec. The VIX tells us about implied volatilities on these, how expensive these options are. Because we're buying an option and we're selling an option, the one we're buying is going to be a little more expensive. The one we're selling will be able to sell for a little higher premium. So they're both more expensive. So they partially offset each other. Okay. In terms of the topic that we have right now on this, though, keep in mind, you can look at individual implied volatilities on these contracts. You can look at individual implied volatilities on these contracts and see where they are, because they're not always going to be the same thing. And you can do that by going to trade and going to up here, and you can click on implied volatility, and you can see your implied volatilities on the individual contracts. In our case, this one is about 41%, and our shorter contract is about 37%. So that's one way to see that. And I see Scott answered your other question there on that, Carol. So I won't add to that. Now, how do we find these? Wiley said, is a bull flag scan appropriate? Yeah, a bull flag scan would be appropriate in terms of this from a technical standpoint. Because remember, the premise of the bull flag scan is the general trend is up. If you're a bullish investor and you're a technical investor, you want the general trend to be up on this because this is overall a bullish trade. If the stock, uh, so not just bull flex, in any bullish scan, it's probably likely that you can probably find some candidates in there for that. Number one, make sure you double check for liquidity on that. Okay. Make sure you double check for liquidity on any individual contract that you do. And you can start with the stock. There's some stocks, if the volume is very low on the stock, you're probably not going to find liquidity on the option. Okay, that's one thing I want you to consider. Here's another thing to consider. If you think the stock is bouncing right there, let's say of course, we don't know what the stock was going to do, but let's say we were looking at this and we were kind of anticipating it was going to bounce up. One approach to doing that would be to buy the leaps at that point, because you're bullish, wait until it's gone up a little ways, and if you think it's going to hit more of a sideways period, that's when you would sell the call. That's true, by the way, whether they're doing a cover call, leaps, or not. If you are buying a covered call and you think a stock is about to bounce way up, you're probably not going to do the whole covered call at once. You're probably going to buy the stock, let the stock go up a little bit, and then sell the call when you think it may go through kind of a consolidation period there on that. Now, what you don't want to do is just find a stock that you think is going to go way down. Of course, again, hindsight is 2020 on this, but let's say we were up here and we thought, oh, this stock may go down a ways. You wouldn't want to do it right now because remember, the net delta is pretty positive, so therefore we'd be losing money during that period of time there on that. So you do need to time it well, but pretty much any bullish liquid option scan, liquid scan would work for your option trades there. Okay, let's look at another example here. I'm going to go to a different industry group entirely. Here's Bank of America. Okay, it's bullish. My assumption is this is going to continue to be bullish. If you don't agree with that, then you wouldn't do this. But we did, we're above our moving averages. We getting higher lows. I don't know if you think this is going to be a very strong resistance that's going to keep this down long term, you probably want to do it. But if you think, hey, this may pause for a little while, at our resistance, but in the longer term, the trend is going to continue up. We kind of have this ascending triangle pattern here right now. This right here is an ascending triangle, which is presumably a bullish pattern. Some people will wait for the breakout on it. Then maybe you would consider something like this. So let me do this. Let's look at our trade price. 100 shares of stock would cost us about $5,400. $5,400. Instead, we could look at the leaps. Again, you can go out however long you want on this. The longer you go out, the more it's going to cost you. I think last contract we went out to January. This one, we'll go out. We won't go quite as far. It'll cost you a little less going out to December. Okay? That's fine. The deltas will typically be, if you're in the money, be a little higher for the same strike price as we get closer to expiration as well. But let's look at this. Let's go here, and I'm going to look for my delta. Now, why am I using delta to pick this? Delta tells us how much the stock option moves in relationship to a $1 move in the stock price, but it also gives us an idea of how in the money a contract is. Contracts with a delta of around 50 are going to be roughly kind of at the money contracts. In other words, the stock price and the strike price are going to be about the same thing. The higher the delta you go on these, though, the more in the money it goes. The more expensive it'll be, the more it will move like the underlying stock in that case. But in this case, let's go here and I'm going to go, let's look at the chart to try and get an idea. By the way, you can also look at the delta and get an idea. If I'm going in the money, I can go to like a 60 delta. It's a little shorter time for this. Is going to be a little cheaper than the other one. This is about a $550 price. Notice that's basically 1/10 of the price of buying the stock, roughly. 1/10 of the price of buying the stock. So when we talk about percentage returns, the percentage returns are going to be basically 10 times in terms of, there's different ways to relate to them, but 10 times the LEAPS versus the stock there in that case, okay? So I'm going to buy this contract here, 52.50. And I'm going to go shorter term here. And I'm going to go out. We don't have the other one, we went 42 days. If it's liquid enough, let me go out 27 days on this. Okay. And I'm going to go here and got a relatively tight spread on this. I'm going to sell this contract here, okay? 55. So I'm going to hold down my control key. So in relationship to the price of the long, this is the short is going to be actually a pretty good percentage of that. The net cost is going to be 435, 440 bucks, something like that. There. And let's just look at the stock. Does our short contract at $55 make sense? You need to ask yourself that if you consider technical analysis. Okay, not all traders use technical analysis. You can just use the basic probability approach and say, hey, my delta was, I don't remember exactly what it was, 35 or something like that, and go with that approach. But I would also say, if you are interested in technical analysis, make sure it makes sense from you from this standpoint. If the call option is at 55, we shouldn't think the stock is about to go flying above the $55 level, okay? Sam says 55 may be a little bit low there, okay? Maybe it is. Maybe that is, because I can easily see it going below there. So let's look at another one. What if we move that up? Before I do that, let's just look here and see what was our delta was 40. Well, we can go to a 30 delta. That's going to be 56. We can go to 57, which is going to be a 22 delta. Okay. So you may be right. You may be right on that. There's no 57.50 for the contracts that I have here. We have 56, 57. We can go to 57. You just got to consider the percentages there on that. Okay. So let's do this. Let me go out and good question, timeless classic. I'll get to that in just one sec. Let's just tweak this a little bit. So I agree. Maybe that 55 in light of the chart, 55 may seem, sorry, I meant to draw a line at 55. 55 is about here. That may be a little bit tight, okay? What if we go to 56? Do you feel better about that? I feel better about that one. 57, at a certain point you can go up, but remember, at that point, is the premium worth it at that point on these? Is the premium worth it on that point? So I'm going to go up to the 56 at least. Let me do this. 56. Debit's going to show a little more. In terms of percentages, the 56, which I'll say 75 cents, 74 cents, divided by our long contract, which was December 5250, say 550, equals about 13%. Okay, about a 13% return in that regard. Okay, so there we go. That's, so in other words, don't just use, well, you can, but if you don't want to just use percentages and use the delta as probability, then look at the chart itself. Look at the chart itself on that and make sure that is reasonable on that. Now, at the beginning of the webcast, I said there is early assignment risk. There is. We're not going to let the short contract get very close to expiration. Now, does that completely exclude the possibility of short assignment? It doesn't. You could get assigned at any time to expiration. But keep in mind, there's going to be two things that really drive up that short assignment risk. One, if it's more in the money, the further in the money it goes, is going to drive up the odds of it. If it's at the money, it's going to be less likely. If it's out of the money, it's going to be even less likely. If it's a little in the money, a little more likely. If it's a long ways in the money, it's more likely. Okay, so more in the money is going to drive up that odds of early assignment. And as we get closer to expiration, the odds of early assignment on that goes up. Closer, I'll just abbreviate EXP, is going to increase the odds of early assignment. That's not just true for this contract. Any of your option contracts, when you're talking about short option contracts, if you want to avoid early assignment, these are two key factors you got to consider on there. The reality is, what drives early assignment is typically little extrinsic value. The lower extrinsic value, the more likely there is to early assignment. Now, someone earlier mentioned dividend risk. Okay, yeah, especially if a company's paying a big dividend, that can be a time of early assignment on this. But its extrinsic value is the key. Extrinsic value. If there's much extrinsic value, the odds of early assignment go way down. Keep in mind, the more in the money you go, the less extrinsic value there is. The closer you are to expiration, the less extrinsic value there is. So that is what is driving the trade here on that. Okay, terms of management. So let me do that. I'm gonna actually send this trade here. Okay, confirm and send. I'm gonna send, and let's talk about management. I'm gonna go a little quicker on this one here. If it goes up, if the stock goes up, well, quickly, we may be patient and look for a little bit of a pullback before we do anything on that. Okay, we could buy it back and roll it out we could roll it out to a higher strike if we want, or to a similar strike. I teach a managing options portfolio webcast on Wednesdays, where often we talk about these kinds of decisions. So I invite you to join me for that. If the stock goes sideways, perfect. We'll probably roll it out. We'll probably look to roll it out at some point, assuming we're still longer term bullish on this. And if the stock goes down a little bit, that's okay. We'll buy it back for cheap, which is great. And then we can sell another contract, unless we decide we're bearish long term, then we're just going to get out of the whole thing. Okay. So that's how we would manage Bank of America on that. All right. Now, when you're considering the long contract, the LEAPS contract in this case, this is a longer term trade. So it may not just be trend. Maybe you start to pull in some fundamental analysis on that. We don't often do that in our option trades, but when you start talking about LEAPS, longer term trades, some traders will look at things like earnings growth, sales growth, cash flow, debt levels, things like that. So that's something you can consider. Here's one other thing I would say about this strategy. I was looking earlier at doing this strategy on United Health Group, okay? United Health Group. One downside on the covered call strategy is you need 100 shares of stock. Well, 100 shares of a stock like UNH, that's $40,000 to buy 100 shares of stock on that. That's a lot of money. And so effectively, it puts it out of reach for a lot of traders. Again, this is not a covered call that we talked about today. Technically, it's a diagonal spread, but it's a substitute I would consider for it, or not a substitute. It's an alternate choice that you have with different pros and cons, but there are enough similarities that I bring it up here with you today. So this may be out of reach for you from that perspective, from just the price perspective. Now, you need options approval to do the diagonal spread. Not only that, you need a higher level of options approval than if you were doing just a covered call. So a lot of you probably won't even be approved for this in that case, but if you are, you may consider on some more expensive type stocks as long as you're bullish long term. All right, everybody. Now, let me just wrap up with this quick summary. We talked about what we call the poor man's covered call. I didn't make that up. That's a term that's been around a long time. It's not a covered call, but it's in a way a cheaper alternative to it with different pros and cons. And you do need that higher options approval level. But I think it's a way of getting into one way to view diagonal spreads, which sometimes are a little confusing to people, to be honest. This is kind of a conceptual way to consider diagonal spreads that makes sense to people by comparing them to covered calls. Now, if you like the webcast, hey, we appreciate it if you click the thumbs up on that. Thank you, Scott, for helping me out in the chat, of course. And make sure you subscribe to that Trader Talks channel. If you subscribe to the Trader Talks channel, you get to see more videos of a variety of topics that are probably of interest to you if you are interested in the markets and investing and trading. Thank you for joining me today. Coming up next, we have market and sector analysis. And everybody, have a wonderful weekend. Happy trading. Bye-bye.